Shares of Chinese companies have not only had a bad start to the year 2024, they have been going down for 3 years in a row. As it became known the day before, the last peak in the value of shares of Chinese companies occurred in February of 2021. Well, since then, the value of the PRC company has been steadily falling down. Over the past 3 years, they have lost about $6 trillion in value. To give you an idea, this amount is roughly equal to twice the UK's annual output. But skeptics or uneducated Russians in the comments under my videos will immediately say, well, big deal. The price of shares has fallen, the stock exchanges are American, and in general, it doesn't mean anything. Everything is fine with the Chinese economy. Hence, on this day, we should delve deeper into the current state of China's economy and discuss the reasons why a 3-year downturn in the worth of Chinese stocks is set to result in a prolonged period of economic inactivity within China. Hello, friends. My name is Alexei Pechi. Let's look into this topic together. But before we start, I ask you to like this episode. Be sure to subscribe to my YouTube channel and click on the bell so you don't miss all my episodes. So, just this year, the Hang Seng Index fell by 10, and the Shanghai Composite and Shenzhen Component Indexes fell by 7 and 10, respectively. Once again, these are all Chinese stock indicators, not American ones. And these astonishing losses, reminiscent of the last Chinese stock market crash in 2015-16, highlight a crisis of confidence among investors who are worried about China's future. But this means that investors are fleeing, or at least in no hurry to increase investments. And on this occasion, Goldman Sachs analysts write the following. Over the last 36 months, investors and individuals active in the market have faced an unquestionably difficult and exasperating time when it comes to Chinese stocks. At present, China's market is experiencing diminished valuations and the smallest investment fund mandate allocations seen in a decade. In general, the world's second-largest economy suffers from many problems, and not only competition with the United States and its consequences are to blame, but also other purely internal factors. This is a record decline in real estate. This is deflation. This is external debt. This is a drop in the birth rate. This is a reduction in the labor force. And besides, there is a shift towards politics that is driven by ideology. And it was precisely this policy that alarmed the private sector and scared away foreign firms. Because in recent years it has been communism, not capitalism, that has taken the lead. And any business must, in one way or another, meet the requirements set forth by the Chinese Communist Party. That is, if we take the period several years ago, then there was still a certain capitalism in China. Now this capitalism is being curtailed again, and communism is being put at the head of the table. Currently, indications are emerging that Chinese authorities are beginning to feel concerned. This week, according to Reuters, the authorities in Beijing have requested that state-controlled banks begin selling off their dollar reserves in an effort to support the value of the yuan. Meanwhile, as of today, Bloomberg has disclosed that the administration under Xi Jinping is gearing up to take direct action in bolstering the stock market values. On Monday, the Premier of China, Li Jiang, directed authorities to implement forceful and efficient actions for the purpose of market stabilization. This is the statement that the uninformed Russians will likely utter, those who have accused me of dishonesty in their remarks on my posts. So, are you prepared to once again dismiss this as mere fabrication from the West? Or is it that Li Jiang is also spreading falsehoods? But let's consider this a poetic deviation. But what caused such a protracted collapse? Investors are concerned about Beijing's lack of effective policies to spark a sustainable economic recovery. China's economy grew by 5.2% for the entire year 2023. This is the slowest growth rate since 1990. Currently, global economic experts anticipate that China's economic expansion will persist in decelerating, reaching approximately 4.5 this year and descending beneath 4 over the medium-term horizon. In essence, the period of rapid growth experienced by the Chinese economy has concluded, with no resurgence foreseen in the foreseeable future. In this context, it's certainly feasible to acknowledge that the expansion we've observed in 4 is commendable. Yet when we bring the massive Chinese economy into the picture, the perspective shifts. Reflecting on the past 10 years, we saw growth rates soaring into the double digits. Consequently, market experts are now suggesting that China might be on the cusp of entering a new phase, which could very well be characterized by a prolonged period of stagnation. This anticipated slowdown is deeply rooted in structural issues, and it is anticipated that reversing it will pose a considerable challenge. Despite these signs, for an extended period, the administration under Xi Jinping has maintained a facade of normalcy. However, those who have spoken out, that no, not everything was fine, they were immediately sent to prison or they simply disappeared somewhere. I have already talked about this practice, in one of the episodes on my YouTube channel with the prosaic name Alexei Pechi. Over the past year, Beijing has pursued only such partial policies aimed at economic recovery. That is, these are half measures and they were done for a reason. But they were done precisely as half measures so that no one would have any doubts that everything was fine with the economy, although terrible. But according to those same Goldman Sachs analysts, this was not enough. Well, I'll give you another quote from Goldman Sachs. The traditional easing of macroeconomic policy has not yet met investors' expectations. Turning negative market conditions around may require a shift from piecemeal policy easing to a more aggressive so-called Big Bang approach. Specifically, with the aim of addressing the ongoing crisis in the real estate sector, a central issue contributing to numerous economic challenges within China, there is a substantial need for governmental assistance. This support should be directed towards aiding insolvent development companies as well as bolstering the desire for home ownership among citizens. In essence, what is required is a substantial infusion of capital, indeed, a significant monetary stimulus. Xi Jinping does not particularly want to take such steps. Why? Because they will publicly show that his economic policies have failed. Conversely, it appears that investors are somewhat displeased by the fact that the Chinese Communist Party is escalating its suppression against individuals desiring to collaborate with Western entities. Fundamentally, investors are frightened by China's insistence that all companies must work for national security in one way or another, no matter whether they are private or state-owned. In addition, Beijing has unleashed the growing dominance of the public sector in key industries, and, as you understand, this does not give rise to any great desire to invest a lot of money, understanding that the key sectors are under the control of the Chinese Communist Party. Well, in fairness, of course, it must be added that tensions in relations between the United States and China also forced American investors to significantly reduce their share in the ownership of Chinese shares. But here containment worked, and this must be recognized. What actions is Beijing currently undertaking in response to this calamity? Premier Li Jiang has pledged to implement strategies designed to invigorate the stock market and enhance the flow of capital. This has been reported by the Xinhua agency, although they have not detailed the specific steps that will be enacted. Nevertheless, in such circumstances, it is crucial to observe the actual deeds when explicit plans are not articulated. On the same day that Li Jiang announced this, which was the day before, Monday 22 of January, China's major state-owned banks moved to support the Chinese yuan to prevent the currency from falling too quickly as Chinese stocks fell. This is another reference to the fact that falling stock prices affect not only companies, but the economy as a whole. Furthermore, based on information from Bloomberg, it is currently under deliberation by the Chinese officials to potentially introduce approximately 2 trillion yuan in budgetary funds with the aim of stabilizing the fluctuating stock market. It is noteworthy to mention that 2 trillion yuan equates to an amount slightly below $300 billion. But, by the way, such an influence of state money, well, essentially subsidizing companies, is not welcome in global trade. And here China may have problems later. For example, the European Union is already considering the possibility of a partial ban on the import of Chinese electric cars into its territory. Why? Because, well, they acted quite competitively in China because, for example, the European giants there themselves survive. And China simply pours in subsidies and gives money so that the company can very quickly would shoot and occupy a niche. Now let us redirect our attention back to the sum of 2 trillion yuan. The intention behind this capital is to acquire shares that are listed on mainland China by way of the Hong Kong Stock Exchange. As can be comprehended, this action is expected to yield a modest stabilization in the price of shares, albeit temporarily. The reason being, at some point, these 2 trillion yuan will be depleted, and the likelihood of fresh investments emerging is slim. Consequently, China will once again face the scenario where stock prices will gradually decline. In addition, there's a possibility that in the next instance the decline could occur at an even more rapid pace. I trust that I have shed some light on the current state of the Chinese economic situation. I invite you to share your viewpoints in the comment section below this video. Make sure to subscribe to my YouTube channel and give this video a thumbs up. Furthermore, if you find the work I'm doing to be significant and essential, and you're wondering how you can contribute to the Alexei Pechi project, all the necessary links can be found in the video description and the top pinned comment. That's all. Thanks to all. Bye, everyone.